Hi, I'm Albert Bowkett from Perfinal Core Banking, and this is clip 9 in my series of Core Banking Essential FAQs. Today's frequently asked question is, what future problems will core banking need to solve? In my previous clip, I looked at the more underlying, abstract, even philosophical design issues in core banking. Explicitly, the role of analytics in automation and real-time provision, the issue of analytical deficit in product introduction, the need for a classification system for multidisciplinary analytics, and the challenges that lie in the way. That's the deeper level stuff. In this clip, I want to look at some of the more specific surface level problems that core banking will need to solve in the near future. With my proverbial crystal ball, I'm going to predict 5 challenges, say a little bit about each one, and suggest how each might be solved. And those 5 challenges are: number 1, automation of AML, that's anti-money laundering, fraud, compliance and regulatory reporting pipelines. Number 2, automation of multiple accounting structures for multiple capacities or subsidiaries. Number 3, making consumer credit more consumer friendly. Number 4, multi-purpose accounts. And number 5, allowing non-tech executives to make full creative use of these new systems. So, firstly, regulatory compliance, the elephant in the room. There are several factors here that have for some time been converging to form a perfect storm for banks, unfortunate enough to find themselves lagging behind regulatory development. First, the legacy of core banking workarounds and workaround culture, which have increased the points of failure and consequently the risk of non-compliance. Second, the recent rise in tech-driven market complexity and real-time demand on services. Third, in the initial wave of fintech innovation, there was this hands-off culture on the part of regulators, apparently to encourage innovation, which has now kind of expired, along with the honeymoon days of tech startups in general. Fines and penalties are really increasing, including caps on new customers and increased liability for executives in the extended chain of command. Plus, as fintechs and neobanks grow, they become responsible for more customers and more service complexity, which means more legal responsibility and more legal complexity. Finally, we see the big return of the international sanction and the expansion of US sanction requirements for US banks to cover their partner banks in other countries. Now, that's especially challenging on the core banking automation level because AML, anti-fraud, compliance, internal investigation as a group is structurally resistant to automation because legally those 4 pipelines must remain separate to avoid scenarios like the fox guarding the henhouse. They are, however, related, and there has to be some managed interaction between these pipelines in order for them to operate. In practice, that happens via functional but slow and bureaucratic emails and interdepartmental meetings. Requests for AML, anti-fraud, compliance, internal investigations are batched and periodic. They aren't real-time because real-time isn't supported. Now, you don't necessarily need to be real-time to be compliant, but it helps, especially when so much of your services are moving to real-time, and especially if it means you can avoid the kind of workarounds that increase your risk of non-compliance. It also makes your AML and anti-fraud more effective because criminals do operate in real time. One way core banking can enable banks to operate real-time automated AML and anti-fraud pipelines is to introduce an analytical level. This allows the 4 pipelines to interact while maintaining the explicit legal separation required. With interaction, automation is enabled, and consequently, real-time operation greater support for real-time services, reduced risk of non-compliance, and more effective rapid response AML and anti-fraud. This solution also works in sync with automated accounting and automated sanction governance with similar benefits. Moving on, my second predicted future challenge is automation of multiple accounting structures for multiple capacities or subsidiaries. Now, first of all, why is this a problem? And secondly, what is this problem? Well, it's possible, routine in fact, to have more than one type of relationship with one actor, and I'm not talking about how they do it in Hollywood, but rather something like a bank being both a service provider to and a client of the same entity. That requires not one, but two separate accounting structures, which are further complicated by all kinds of time-dependent and legal-dependent factors and events. You make a payment, it needs to be refunded later, but what about the interest accrued in the meantime? What if there is a foreign exchange involved? What was the rate then and what is it now? All that complicates one financial structure, but what if you have two or even three financial structures that are all connected? Or to put it another way, you need to look at the same transactions but from various points of view. Mathematically, there is always a solution, but synchronizing separate accounting structures has so far resisted automation. Resisting automation means it's not real-time, it's a manual task, and a complicated one at that. I don't think complicated accounting structures are going away anytime soon, and there are some notable examples of multiple structure scenarios. One is where you have a parent company and its subsidiaries. Another is for an e-money institution that wears different proverbial hats. And a third is for CBDC, or central bank digital currency, where the central bank is operating in multiple capacities in addition to its primary traditional role as regulator, because it could be acting similar to a commercial bank with CBDC. It could be a client of a commercial bank. It could be even reporting to itself. Whatever the case, there is a need for an automated solution to synchronize multiple accounting structures in order to make it real-time and to reduce human error and ensure pristine bookkeeping. My third predicted future challenge. This is about making consumer credit more consumer-friendly. The big fintech buzz in the last year was BNPL, or Buy Now Pay Later, at the point of sale, allowing consumers, especially online consumers, to spread their payments over installments. This is hardly a new concept, but what freshened it up was a fintech injection of speed and simplicity. Customers previously had to go through some kind of lengthy paperwork process, a credit check and verification. Now this payment option was instantly available at the point of sale and instantly approved. And it's that smooth, simple, uninterrupted customer journey that made Buy Now Pay Later take off almost overnight in popularity. Obviously, consumer credit in its various forms is a massive part of what banks do. It's also got its own risk management requirements, and it's traditionally quite customer service intensive. There are a lot of regulations and customer vulnerability considerations to think about. So most forms of consumer credit are unsurprisingly quite clunky, slow and bureaucratic. The opposite, in fact, of the smooth and simple customer journey that banks, retailers and customers would like to see more of. In other words, it's considered ripe for disruption. On the regulatory side, tech now provides things like automated onboarding and biometric security. Refinements in customer management and admin interfaces, combined with more intelligent and accessible personal financial management interfaces for consumers, can provide proactive support, off-ramps, and more efficient use of human support for the vulnerable consumers who need it. And AI can play a role in this early identification too. Scoring engines represent another target for increased automation. This is exactly the kind of area where core banking and open banking fintech need to work together to ensure a seamless customer experience, supported by a synchronized back end. But what about the loan products themselves? As we've seen in the past, core banking tech innovation can drive product and service innovation, and we are at a similar junction now. An example of that is the intriguing proposition of flexible loan repayment. Most homeowners with a mortgage will have probably considered making one-off occasional repayments in excess of the minimum monthly amount in an attempt to pay down the loan faster and so reduce the nasty long-term effects of compound interest. Many mortgage providers allow this, but in a quite prescriptive and restrictive way. Obviously, the loan provider will set limits on how much a consumer can pay back before some kind of surcharge is imposed. But even within those limits, it is conceivable that a consumer could be offered much more flexibility on repayments via a smartphone PFM app, perhaps linked in with a wallet-type feature that the user can set up to harvest small savings from various monthly expenditures and redirect them to paying off a loan or several loans, or automatically spread them across those loans in a smart, prioritized way. That's the front-end user experience. This kind of flexible loan repayment would need to be supported in the back end by powerful real-time loan recalculation. That's the kind of thing that core banking hasn't been able to fully achieve in the past, but feasibly can now. This would transform consumer credit into much more fluid, flexible, accessible and managed services within the industry, with the consumer receiving a much faster, more tailored, supported and empowered experience. My fourth prediction for future challenges in core banking is the multi-purpose account. You probably know about walleting, which allows consumers to set up wallets or pockets within their accounts, almost like files within a file. Only the consumer can also set up automated transfers between those wallets. Building on that strategy, core banking could provide loan accounting, current accounting, and savings accounting all within wallets within one single account. The advantage with this is that any transfers between these wallets would be instant and free. Now, we probably think that the existing system is instant and free already, but in reality, it isn't, and still depends on some of those legacy workarounds and hidden manual processes mentioned previously in this series. The multi-purpose account bypasses the structure that required those workarounds in the first place. It also reduces transaction load on the system. It also means you only need one IBAN number for the 3 account purposes. And again, it gives the consumer faster, smoother experience and more control at their fingertips. My fifth and final prediction is one for the financial executives. One of the problems we need to overcome is this situation where you have the consumer at the front end experiencing all of this hyper-convenient, seamless customer journey through shiny user interfaces, and then behind the scenes, the admin or customer support getting their nice shiny UI, and then the poor old financial executive grappling with conflicting systems, very limited interfaces, and face-to-face meetings with tech support when all they really want is to make relatively small changes and updates to their workflows instantly, as and when they need to. As core banking becomes more analytically driven, as opposed to being reliant on designs based on a kind of wiring, they become truly real-time and controllable in real time. That means financial designers, chief financial officers, other financial executives who are non-tech, not computer programmers or developers, can use their own intuitive graphical user interfaces to design, create, and test financial workflows, and then either export those to a spreadsheet or in fact execute them to the core banking platform itself. Not only that, but with the new core banking, financial executives should be able to work with different interconnected layers or maps. The physical layer of accounts, the analytical layer of legal business and financial ownership, and the synthetic layer of accounting categorization and general ledger aspects. This gives operational control back to the financial executive. It also gives creative control. It's a visual, interactive toolkit that essentially lets financial executives draw their bank and press play. Those are my 5 core banking predictions for the near future. Only time will tell which of those will come true. But in my next and final clip, I'm going to offer a brief summary roundup of this entire series of core banking FAQs.